This is Jeremy Wentworth-Stanley. I'm the fellow who has a hyphen in my name. The hyphen is silent, but I am anything but that. This is the second week of August. Jeremy Wentworth-Stanley, the voice, the year of Respectonomics, and we are looking at living economics. And what we're discussing today is the shape of the stock market. Now, before I go any further, let me be very clear that the stock market is not one on which I will make any recommendations, or any consultations, any approvals or disapprovals. This is an open-ended discussion of the shape of the stock market and talking about some of the things that we may want to consider or you may want to consider. I want to be very clear with you before we go any further that living economics is designed to be a platform that opens discussion, brings us to the realities of the economy today, tries to move away from the disguises and the camouflages that we seem to get pushed at us from the heads of various organizations like the Federal Reserve and so on, and really talk about some fairly practical things about the way we live and the way we eat and the way we shelter ourselves and so on. So in that context, I'm going to be talking, as I say, about the shape of the stock market in a non-recommending kind of approach. And I want to talk a little about, first of all, what is the state of the economy today? How do we feel about it? August 2026. What's it all feeling like? And I think there's one or two things that spring to mind. And that is we have a feeling of anxiety. We have a feeling of division or disunity. We are aware of debt levels, whether they be governmental or whether they be corporate. We're very aware of the disruptions and the unknowns of artificial intelligence. We understand or think we understand protectionism. And of course, we're dealing with the climate issues. And, I think a lot of us are dealing with a sense of security of the food supply. And that's because of a combination of restricted shipping and transportation, the expenses of transportation. Look at the price of diesel. And at the top of that, and in addition to that, looking at how the security of supply of food can shape up with all of these disunities and the difficulties around us. And all of this may sound like gloom and doom. And if you look at us historically, we actually, and let's not surprise one another, we have always encountered uncertainty. So when people say today it's never been so uncertain, it's always been uncertain. We're full of surprises, things that happen that shouldn't, and so on. We have failed expectations, and we look at things that we thought that were going to go up and they go down, and we think of things that we thought were going to go down and they go up. So this whole sort of cosmopolitan mix and match of how things happen in society and around us and so on, probably there aren't any great surprises. I will say though, and this is where 2026 scores are sort of hit out of the ballpark, and that is we are facing volatility, velocity, and extremism. I think we can add those three into the mix from previous periods of our understanding that things are very volatile, things move very quickly, hence the word velocity, and they go to extreme issues. Many years ago, I was taught in the financial industry to think of extreme possibilities and to recognize that those extreme possibilities had two characteristics. One is that they would, in fact, happen. And secondly, they would happen a lot sooner than we thought they would. So, with velocity and volatility and extremism and these anxieties and so on, how do we shape ourselves, or how does the stock market shape itself into our thinking? And I think the first thing I want to point out is that the stock market is an expression of ownership. if you own 100 shares or 500 shares of an organization, you are a part owner. Now, in the world today, there might be millions of shares out there. Look at SpaceX. But the fact of the matter is, if you own a share of SpaceX, you own a share of the company. So what we're talking about is ownership. And so therefore, all I'm doing is looking at the stock market through the filter of ownership. That's all I'm doing. I'm not presenting it as an alternative to other investments particularly. I'm not making any recommendations as to the mix of how one would engage in the stock market. I don't want to do that. I want to talk about the stock market as it relates to what are the right approaches that we can have to investing. And I think the first thing to do, I've got sort of 4 points I want to make here. And the first one I'd like to discuss is the concept of a relationship. You see, in the business world, I can have three levels of engagement with with a customer or a supplier, or shareholder, whoever it would be. I can have three levels of relationships. I can be a visitor, I can be a peddler, and I can be one who wants to have a relationship. In the case of uh, the visitor, that's just like taking a sort of casual glance. That's like picking up, looking at a Yahoo Finance page and saying, oh, that's interesting, and going on to something else. The peddler is the one who wants to force something down your pipe. And this is one thing we are not going to do. We're talking about here about relationships. And if you think of a relationship, I want to look at what I mean by a relationship. And there are two or three things that come to mind in a relationship. We think of deepening our understanding of a person's needs and what we can offer. We think in terms of diversity of relationships. Do we not think about relationships as being in one area very important in our, let's say, in our lives of having partners, and another way we may think of our relationship in terms of somebody that we rely on to be delivering goods, products, and services. All I'm pointing to is that it's fairly obvious, really, isn't it? That relationships are different for different reasons with different people. But we have this diversity of relationships. We have this idea that we want to deepen our relationships. And we also like to look at our relationships through that filter of good advice and good counsel. I think most of us have understood that we can have a relationship with another individual, and it can go up and it can go down. And occasionally we may need some outside help, some outside advice. In other words, things may have gone very well or things may have gone very badly, and we look around to see who can help us out. Now, all I want to say is if you think of your relationship with another human being, supplier, shareholder, whatever the arrangement would be, that's not the issue. But I want you to look at relationship. And when we look at relationship, that is a very good filter, a platform, a filter through which we would then select investment. You think in terms of you want to invest in such and such a company, and you do it through the facilities of the stock market. So we're agreeing you've got ownership. We've already established that. Now we're talking about what is the relationship I have with that business? And this is the key point. Am I there as a visitor where I just shake my head and just think, okay, well, that'll do? Or am I there as a peddler where I can become a sort of almost like a gambler and run it up the flagpole and just demand that it's going to give me returns? Both of those ways of dealing, we know they don't work in relationships and they don't work in investing. But what does work in investing is when we establish our approach as one of a relationship, that we want to have a relationship with that particular business, that particular entity. And we understand that relationships are a long run kind of formula. We understand that relationships have their ups and their downs. And we also understand that we want a diversity of relationships, just like you want a diversity of investments that will be congruent with your own different needs and aspirations. So just think of a relationship that matters to you and apply that to the relationship that you would then want to have with a particular investment. And one of the things we said earlier was that we thought about if your relationship is going well or badly, you think in terms sometimes of consulting with somebody. You say, I'm having troubles with, or this is going extremely well. Do you have any thoughts on it? When we think about getting that outside advice, it might be that friendly favorite uncle that gives you the advice. It might be a colleague at work. It might be a trained therapist. But whenever we go for that kind of counsel, you always go for counsel and help where you know that you can trust the advice. Very important point. So we're looking at the concept of investing through the filter, through the idea of a relationship. That's what we're talking about. And we're then saying, well, we may need some help and some advice. We may need to consult. And one of the things we do is if you want that advice, you need to go through the advice that you can trust. That seems straightforward. So in the world of finance, that whole idea of having an advisor, somebody that you will talk about how things are going and the mix of things and so on, your advisor needs explicitly to be somebody you trust. And that is something we want to talk a bit about now, is how do you develop this trusting relationship? How do you do that? And there are two or three things that you can do that are really quite helpful in understanding this trusted advisorship. And the first thing is when you meet that individual who you believe is going to be an advisor for you, is one question. How do you do your business? It's kind of interesting. You get some quite often, frankly, you get some very sort of, I don't know, complicated answers. They should be very straightforward. And when that advisor explains how they do their business, you then have the subsequent corresponding right to ask one question. Well, it's actually three questions, but it comes out as one. To ask a question of how do you verify your information? And when you say how do you verify your information, you do so through three filters again. You do it through the filter of accuracy, consistency, and reliability. So let's look at those three when you're looking at this advisor. You've asked how this individual does his or her business. We've got that established. And they say, we do this, this, and this. And then you say, and how do you verify your information for accuracy, consistency, and reliability? Let's take a look at those three. Accuracy means that they've kept records. They actually can say, this is what we've recommended, this is what we've done, we did this 10 years ago, this is how it's turned out. Great. Then we look at the issue of consistency. And when you see straightforward, gradual improvements and enhancements and this kind of thing, that's pretty warming. What you don't want to see is a volatile mix because that volatile mix of performance is going to become accentuated by the volatility of what's going on in the overall markets anyway. Then you look at this rather strange word, really, reliability. And reliability is something you can say, yes, we've had this advice, we're offering this advice over a 5 or a 10-year period. But you've got an idea that this doesn't go back just a couple of weeks. This goes back maybe 2 decades. So you've got the accuracy, you've got the consistency, you've got the reliability, and you know how they do their business. When you've got that amalgamation there, you've then got a starting gate to developing a relationship. Beyond the relationship with the investments, you have a relationship with the advisor. Let's move on then to what would happen if you were at a shareholders meeting, because naturally, if you think you're going to be investing, you might want to go to a meeting. And there is one question that begs to be asked when you're at an annual meeting. You always get the glitz and the glamour and all the things that they're doing and all that stuff, and that's fine. But there are two or three thoughts that go with how you address the CEO or the chair of the board. And your first question is, would you please explain your principles of governance, how they relate to delegation and accountability within the organization? Within the organization. Governance is a very important word. It's not government, it's the governance, it's the principles of how are the duties and the assignments carried out? How are they allocated? Delegated is the word. And what is the extent of the accountability of that individual? So if you say to someone, oh, you're going to be asked to build a new brand, you've delegated the brand responsibility, but now you're looking at the accountability to say if it's successful, these are going to be the rewards, and if it's not, these are going to be the way of looking at the exit. But whatever that is, the delegation and the accountability, you need to be able to say under the heading of governance, what is your evidence? And I think you'll find that a lot of corporations do not have a clear, delineated understanding of governance, of accountability. The accountability you see too often is the one that breeds mistrust. It is that accountability when there has not been a successful adventure and the individual is able to leave with substantial financial emolument, with great sums of money, in other words. And that is not exactly what accountability is meant to present. And there's another thing too. We've talked about delegation, we've talked about accountability, but you want to hear under the heading of governance. Governance has one very important principle. It's called capacity building. So what is it within that governance that the corporation is presenting that gives the drive and the platform for capacity building? Because after all, if you own a business, to state the obvious, you want it to build capacity. That's the whole point of it, which leads then to the next thing. So we've talked about governance through the filter of accountability and delegation, the evidence of the governance. We've talked about building capacity. But there's one last thing, and that is to ask the chair of the board through whether you go to the annual meeting or whether you do it through emails or whatever, is how do they view shareholder rights? You see, the thing is, the board of a company, any company, is actually there to protect and to build the shareholders' rights. And I said shareholder, I did not say stakeholder. There are stakeholders representing in the arrangement of a corporation between suppliers, customers, employees. The list can go significantly. They are stakeholders. I didn't say that. I said shareholders because when one is investing, it is you and I who are the shareholders. We are the ones who have the ownership. We are the ones who depend on the board to protect our interests, specifically in relation to the value of our investment. And you need to be able to hear from the proverbial horse's mouth what that looks like. So there's the what you would say to the board or to the chair. And I think one of the problems that we are all experiencing today is this distance between the shareholder, the owner of the business, the stockholder. We're seeing a distance between that and the management and the operations of the company. And that distance needs to be narrowed. And that's what these questions are doing, is to bring the company closer to the shareholder, him or herself. Now, the next thing we want to talk about is how do you invest? It's a question that you can sit there at the table and say, I know how you do invest. And there are three determinants to investing. One is, it seems so obvious, doesn't it? It's to understand the company. Just understand it. Understand what they do. Understand what they make. Understand who the buyers are. Understand who the competition is. Understand the risks. Understand the strengths. Understand if there's a moat around the business that no one else can cross into. So you've got an exclusive ability to produce or provide, whatever it might be, but understanding the company. And I think that it's more and more difficult now to get a clear understanding of the entire corporate fabric, the tapestry. But we do need to be able to understand the company, the business. Then we want to ask another question, and that is, what is the dependence of that business on debt? We briefly mentioned debt at the beginning of this discussion, talking about how debt levels have become so high, both corporately and in government circles. And what we're saying here is if the company shows an undue dependence on debt, then the old problem is that when the the call-ins come, call-ins on debt always come at the worst possible time. And you don't want to be looking at a company that doesn't have the strength or the flexibility to meet those debt calls and obligations. So although debt has a wonderful way of producing more capital on which you can grow your business and so on, it carries a corresponding risk that someday somebody may say, I don't like the shape of your business any longer. I'm calling in the debt. And if there's a lot of debt, that can lead to the destruction of the company. So we need to understand the company. We need to understand its dependence on debt. And here's a very personal way of investing. It's really is quite successful. And that is this. Supposing you're a stockholder in the ABC bakery and you own one share, and let's assume there's a zillion shares out there. Doesn't make any difference, but you own one share. But as an owner, imagine for a moment that that ownership is in fact 100% ownership. So in other words, by putting your finger on the pulse of one share, you're actually taking on the entire operation. You own it. And you become Mr. or Mrs. ABC Bakery Corporation. That's who you are. And you're walking down the street, and now you are recognized as being the owner of this company. And as you walk along, somebody says, "Ah, there you are. You're the head of the ABC. You own ABC Bakery." And here's the question. Would you feel proud or would you want to dart into the shadows? Because if you want to dart into the shadows, that's a way of saying that's not a good investment. If, on the other hand, you can proudly look up and say, yes, I own this wonderful company. I love the product. I love the company. I love what they do. I love the employees. I love the shareholders. I love everybody who's involved in it. When you have that sense of pride in this organization, that in and of itself is a brilliant template or a brilliant testing ground to knowing whether or not one should be in. The last thing I want to talk about is most of us are very good at thinking about and contemplating how we're going to buy an investment and how we're going to buy land or whatever it is we're going to do as an investment, and that's fine. But here's the one thing we often miss. And again, this can be put forward to the advisor, but more importantly, it can be put forward to oneself, to you and me as the investors. And that question is, or thought is, what is the exit strategy? Because every investment at some point needs to be realized. If you say, no, I'm going to leave it for my great, 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 great grandchildren, well, that's fine. But most of us have a sense that we are in, and at some point, we actually theoretically, or no, to be practical, want to be out. If we want to be out of the investment, we need to have an exit strategy. What are the determinants in our lives, in the performance of the investments, and so on, that say to us, yep, this is the time to be moving along. Let me give you a couple of clues about getting out of an investment. And one of them is that it is always better to be 2 years too early than one day too late, which is a very sort of almost puritanical way of saying, do not expect this growth to be forever and ever, because if it does stop, you may be stopped out in a fairly significant way. So the exit strategy requires us to be not necessarily humble, but not necessarily to allow ourselves to become so blinded by the growth or the prospects that we don't actually see the realities. So let's take a look at this whole picture. We're looking at the stock market as a vehicle of ownership. We're doing so at a time when the economy and the politics and the socio-economics and so on are in a state of, let's just say, roughly speaking, chaos. There's a lot of mistrust, a lot of misinformation floating around. And what we're trying to do here is to bring this into the into your own home to be able to look at things that you own. You can have an investment. We tend to think of the stock market as being a place of investment, but a place of investment includes myriad opportunities, including your family, including your friendships, including your community. There's different ways of representing investment. We've talked about the financial one, which is in many respects, when you look at financial investment and personal investment in terms of one's life and what one does with it, the parallels are very powerful. And if we allow one of those to take leadership over the other, we run a risk. If we look at these ways of investing in the community, for example, and parallel those into the way in which we invest in, let's say, financial assets or into real estate or whatever it would be, when we start thinking along similar parallel lines, we do tend to come up with some great results. This is Jeremy Wentworth-Stanley. I am your voice, your year of Respectonomics. This is Living Economics, which is the model that discusses economics. I want to emphasize two things. One is, of course, that we are available for consultations and meetings and workshops and the like to talk about some of these ideas, because we find the exchange of ideas is where we do build capacity. We also want to point out that we are in a parallel. We are running the Living Journey. Living Journey is more of a personal way of looking at one's life, where we are today, where we want to be, and giving us some techniques and tools to be able to do that. I want to take this opportunity to thank you for listening. I would like you very much, please, to let me have your thoughts and afterthoughts and your afterburn and anything you want in connection with these issues we talk about, as well as if you want other issues put on the table. There's a significant team behind Respectonomics, all shapes and sizes of people from different industries, different activities, some still working, some retired, and so on. So we have a great pool of talent on which we can draw. And we have no pride of authorship. The idea is to be able to take ideas and to move them around to see how do we get the results that are optimal to all of us as we struggle through these times and so on. My name is Jeremy Wentworth-Stanley. My email address is jeremy@respectonomics.com. Jeremy, Jeremy, at Respectonomics. That's a word that is a hybrid designed to express the economics of providing respect one for another. Jeremy@respectonomics.com. Very much looking forward to hearing from you. And in the meantime, thank you for giving me this opportunity to hear from me. We'll chat around. Goodbye.